Everyone, David Moore, Equity Advantage. Thank you for joining us today. And we've got an hour's worth of great material, timely material. Going to talk a little bit about our crazy 1031 tax code. Again, we're under attack, so we're going to talk a little bit about that, what they're talking about doing with capital gains tax rates, and we'll just go over seller finance, why you'd use it, what to look at, what not to do, and hopefully it'll be something that you get something out of. Those little nuggets of knowledge, I think, are always a great situation, and something that's very, like I said, timely. We're doing a lot of right now, and for a variety of reasons. I think it's sort of a minefield. People need to be aware of what's there, and it can be a great end game if you're looking at a way to sort of be done with real estate and you just want income over time. You just need to understand, really take advantage of your tax and legal people. Sort of interesting. I had a meeting last week with a lawyer we were looking to do some big projects with. And it was funny because he'd actually spent a lot of time watching our videos on YouTube, and he asked me a series of questions when he came in, and I felt like it was profiled, honestly. Sam, if you're out there, I got to laugh, but really it was great meeting you. And he made a comment to me. He says, through your videos, you're always talking about great tax counsel, and yes, that's very, very important, but good lawyers obviously too, and I totally agree. I don't talk about the lawyers that much in the presentations because honestly there's not a lot that needs a lot of legal work done. But if we're in a situation where you're doing something that's sort of on the edge, then obviously it's a great idea to get your tax and legal counsel involved both. And I'll just say, we don't sell investments. We don't provide investment advice. We're just a conduit out of what you don't want in the tax world via 1031 and Equity Advantage. If you're in the qualified world, IRAs, 401ks, and you want to make investments outside Wall Street with those, we're the source of that investment vehicle as well. So you don't have to worry about me trying to sell you some investment. We don't sell investments, nor do we provide investment advice. We do want to make sure that the exchange makes sense to you, though. I mean, there's definitely an opportunity cost to a 1031 exchange. And that opportunity cost is really there because you've only got that 45-day ID period. So 45 days from settlement date of that relinquished property to ID what you're going to acquire. If you're doing a reverse exchange, you've got 45 days from the date of acquisition to ID what you're selling. So just real quickly with reverse exchanges, don't get yourself in a spot where you try and get something done and somebody says, well, just go buy the property today and you can do a reverse later when your property sells. You cannot legally own both the new and old property at the same time. So it's really critical that if you're contemplating a reverse exchange, do not buy it, close it without our involvement. Get your combinator involved before you sell or buy anything if you want it to be part of an exchange. So I'll say it again, reverse is a great tool. It allows you to buy a property today to replace something yet to be sold, but you cannot go out and buy the thing without the accommodator being involved in structuring that reverse exchange for you. So, with that said, David Moore is my name. Equity Advantage is the firm. My brother Tom and I started the firm with actually our investment mentor, a guy named Ron Stash in 1991. And during the ensuing years, we put IRA Advantage together to handle the qualified money IRA 401k investors that want to go out and buy things Wall Street doesn't sell. So, give us a call. The only dumb questions are the one you don't ask. If you got questions on things 1031, give us a call. If you got questions on anything IRA 401k, give us a call. We're happy to talk to you, and you're going to hear me say over and over and over again, the only dumb questions are the one you don't ask. So really take the time to understand what you're doing before you get yourself in a situation where it's too late. Even though 1031 is over 100 years old at this point, we still get contacted after closings. And people, just yesterday, I had a tax professional that I was conversing with, and she said, she had somebody just last week call up and say, hey, I just sold the property, I want to do an exchange. And she said, well, did you settle on it? And yes, the person settled on it. It's just too late. So really slow down, take the time to understand what you're doing and where you want to go. If you've got ideas on different things, give us a call. I mean, it's one of those things where people just want to text or email back and forth on things, but a conversation can really cut to the core issues very, very quickly if we have a few minutes to talk. If you're a broker, I really encourage you to get your investors on a call with us, or come in, sit down with us, because that way we're all on the same page. Everybody understands what's going and how we're going to move forward. So here we go. Save 1031. Now, like I said, I don't. When my brother and I put the company together, we were warned that this thing was going to be attacked through the years, and even though it's over 100 years old at this point, yes, it's under attack once again. So if you file, dig through the master platform, the 24 master platform, the Democratic Party, you see the link at the bottom. If you're curious about what's in that plan, take a look at it and understand. And we've got a few things in there that are very damaging to real estate, for example, and just investments in general. Everything from going mark to market, to elimination of 1031, to elimination of long-term capital gains tax rates. We're going to talk about that a little bit, because 1031 is not always applying to long-term capital gains tax situation. If you look at our YouTube channel, which I would encourage you to do if you have questions on different things, 1031 or IRA, the most viewed video we've got on there is the fallacy of the 5-year hold. Well, actually it was, it's now seller finance, but that 5-year hold has to do with an acquisition of a property, future conversion from investment to residence, and then a future sale. If you sold the property within 5 years of acquisition, it's a fully taxable sale. After the 5 years, you're going to be subject to something called the Housing Assistance Tax Act, which, once again, you've heard me say it many, many times. You've been on these things. I don't know how they come up with these names, but it's anything but a tax assistance. It really sticks it to the property holder. So Housing Assistance Tax Act is a horrible thing. And it really sort of has eliminated people's ability to convert assets and utilize Section 121 going forward. But in that tax plan, take a look at it. And at the bottom of page 16, there's one little paragraph in that packet, and it just says, says what it says. It's in italics, exactly what it says. And I've got to tell you, the last election, we were actually not a last election. It was probably 2021. It was after Biden was elected. We did look at, and we fought, because at that point, what was proposed is to cap annual deferral to 500,000 per person per year, and so any gains in excess of that, you could not get the preferential treatment of 1031 on. So understand that the last few times 1031's been attacked, it's been a situation where they're capping capital gains deferral, and now it's just complete elimination. And if you look at sort of the verbiage in this proposal, and this is the exact proposal out of that plan, I mean, it's pretty aggressive. I mean, talking about tax scams and everything else, and 1031, if there's a tax program that gives the everyday Joe a benefit, it's 1031. You don't have to be uber wealthy and pay that $1,000 an hour lawyer to help you in this stuff. You don't have to figure out some complicated trust scenario or any variety of other tax plays to get this done. It's the one thing that for maybe $1,000 you can get deferral, and it's free to anybody. In the over 33 years that I've been involved in the business, I can't tell you the number of investors we've worked with that started with nothing and have really have done very well. I've got immigrants that have come into the country. One gentleman that real great guy, he came in and from Asia. He worked as a janitor, did everything he could to get ahead. The classic immigrant to America, and just worked and worked and worked till he got his first property. Then he got another, and he's done a number of exchanges with us through the years. And this program has made it happen. But if I look at the last time this was proposed and how we actually fought successfully, I've got to thank the National Association of Realtors and the Federation of Exchange Accommodators, but amongst many other groups. But if we look at what happened last time, we just simply showed the government, it's like, look, you want low-income housing. You want good housing for people. Imagine a world where you take 1031 away and nobody can sell a property. If you're a broker or you're an investor, think about any time a property is sold. Does the buyer improve that property. And sort of the BC properties today are the ones that are under attack, and they're the ones that we need for low-income housing. And if you're not allowed to turn these properties by elimination of 1031, what's going to happen to those properties? And to add insult to injury, if you get rid of 1031 and you virtually double the tax consequence of a sale with elimination of long-term capital gains tax rates, think of what's going to happen to that market. And we've shown them over and over again, you take these things away, you increase tax rates, you get rid of 1031, it stagnates the market. Your market velocity erodes. And why that's important to everybody, on top of keeping the real estate vibrant, is you think about every real estate transaction. Who's getting paid in a single deal? And all those people, all those vendors are paying normal income tax. It's going to go away. So you've got appraisers, you've got inspectors, you've got finance people, you've got tax and legal people, you've got the brokers, you've got title escrow people, you've got us, you've got Home Depot, you've got the contractors. All of those people are involved with a single transaction. So it's really critical that we understand and don't just look at it and say, well, gee, if we get rid of 1031, we're going to get all the gains, and it's going to be, it's going to be great because we're going to get all this additional revenue that we're not getting today. And it's this horrible thing for the wealthy. It's not for the wealthy. It's for the everyday person to get started and be able to work forward. Now, obviously, wealthy people can take care of that. Also, they can also use 1031. But it's one of those things where maybe on paper it looks great, but in application it's a totally different thing. I would encourage you to take a look at this master platform and really understand what it says. I would also really think about what repercussions it's going to have in your life. And last time it was proposed, I've got to say that there are different regions in the country where properties aren't worth that much. And I had conversation with the brokers when we were looking at 500 per person per year, and they said, well, gee, my market, the properties aren't worth that much. The gains aren't going to impact my people, so I don't care. Well, next time it will be coming to you. So really understand, look at it, think about it. And my father always used to tell me, it's like, really dig into stuff. Don't take other people's words on things. And it was always amazing. He always put it forth. He says, anytime you read something about something you know something about, you know how wrong it was. So really go into this stuff with critical thoughts and do it. And that's why I'm saying, I'm putting this up here for you, but take a look, understand what proposals are coming out of both parties and how they're going to impact you. And if you're a professional working with investors, how it's going to impact those investors, how it's going to impact just that world. So I'll get off my soapbox, but it's really important that everyone out here is aware that 1031 is once again on the chopping block, and we really need to let those people that make these decisions know how we feel about this stuff, and really talk to your constituents, talk to the people in your fields, and understand what it's going to do to you. So you contact us. Like I said, we don't sell things. We just provide the investment vehicles, get out of what you don't want into what you do want. And we're going to do that with 1031 or IRA and 401k funds. We're here to help, answer your questions, help you get where you want to go. So why do an exchange? I mean, it's simply, it's really an investment decision. That's all it is. Every dollar you save, you've got maybe 3 or 4 more to reinvest. Why 3 or more? Because typically you're going to have leverage on those things. So if you're selling a piece of property in today's world, and I've got to go back to 2017, for example, and understand Trump's 2017 tax reform is that thing's up in the air too. That's to be either sunsetted or renewed at some point. And I mean, that thing contains some things that were great, maybe the reduction in taxes on corporations, but it also took all the personal property out of Section 1031 and replaced 1031 in that world with QOZs and OZs. And there's been some great examples of opportunity zone projects, and there's some where there's some abuses to that too. But you've just got to look at this stuff and really understand what's going on. If you like 2017's tax reform, probably ought to reach out to your constituents and really push to have it renewed or extended. If you didn't like it, maybe push to have it sunsetted. But that's something to be aware of. And when you're looking at why to do an exchange, it's a simple decision. understand anytime you go to sell something what your tax consequence is going to be. And if you're going to go buy, let's say, if you want the money to go do something else, the opportunity cost is you're going to have to do this within the 45 and 180 if you do an exchange. If you pay the tax, now you've got that pot of gold on the sidelines, and you can jump on any opportunity you want at any time you want. So that's the big question: is at what point do the gains, really the tax on the gains exceeds the benefit of just paying the tax and having that money free to go do something. And that's an entirely, a question's entirely up to a given investor. I've had people that'll gladly pay. One guy just said, well, gee, my tax, it's 800K. I don't care. That's fine. Doesn't mean anything. I'll just pay the tax. I'll have the money on the side to go jump on stuff. I had somebody, CPA actually, 5,000 in gains, few thousand, maybe 1,500 in tax. Exchange at that point was 500. She said straight up, I'm not paying anything. I'm not going to do it. So I gave up a long time ago, drawing a line on what is going to make sense for a given investor. And also understand when you're working with your tax people, and don't, if you've got income properties, you've got to have good tax people, but really work with them to understand what you're doing and how what it's going to save you, and really look at, don't engage them April 14th. Well, do that if you haven't engaged them at all, get it hold them before tax returns are due. But really before your year expires, reach out to them, take a look at stuff, and you say, well, gee, I sold this property, I've got gains here, maybe I've got some losses in Wall Street I can offset the gains with. So having tax exposure is one thing, actual taxes owed is quite another, and that's going to come back to that team of professionals that you really work with to get you where you want to go. But you're really, anytime you contemplate a sale, first thing you need to do is talk to your tax people, understand the potential tax repercussions of that sale. Then you can decide whether the exchange is the right thing to do or not. It's not always the correct thing. And if you've got questions on different options beyond 1031, you can take a look at our YouTube channel. I do a presentation on end games. It covers a variety of options. And honestly, today's presentation is one of those, installment sales. So what is gain? Gain has nothing to do with profit. Gain has nothing to do with net equity coming out of a transaction. I've got a lot of people that'll say, well, gee, I sold. Maybe I did a couple of cash out refis during the time I owned it. When I close it, I've got virtually no money coming out of it. Do I need to do an exchange? Well, whether you have money coming out of that sale is totally irrelevant. Gain is simply the adjusted sales price minus the basis. Your basis as a property is what you paid for plus capital improvements minus depreciation. Now, I'm on the phone all day, every day with people talking about these things, right? And you've got to understand that a lot of times people don't keep track of these things. When you do an exchange, there's a form 8824. I want to stress right now, 1031 is tax deferral, not tax elimination. So the basis gets carried forward, the gain goes forward, and it's going to keep doing that as long as you do exchanges. And understand also that there are certain states that will claw back deferred gains. Oregon came out with the claw back first. California said, hey, that's a great idea. They implemented it, and others are probably looking at it and wanting to do the same thing, because what was happening is we'd have somebody sell a property in a high tax state, and they'd exchange into a no tax state, hold the property for a year or two, and they'd get rid of that state tax consequence. Might save them anything from 7 to 14% in California in today's world. So it makes a huge difference, and so that went away. It used to be a great idea. It's not anymore. It doesn't work in certain states. So Oregon, I'll say it again, Oregon and California, they claw back deferred gains if there's a future taxable sale. If you continue to do exchanges, you're going to be fine. But if you look at that stuff, the purchase price, I've got that big number 1 there because it varies depending on how you got the property. If you pulled money out of your pocket and bought it, well, that purchase price is the actual purchase price. That number is the starting point. If you did it at 1031 into it, the purchase price is not. You've got a deferred gain that put forth, and so whatever the gain is, subtract from the purchase price. That would give you, that number maybe. You've got a situation where maybe it's 1033 involuntary conversion. Pre-1997, 1034, the old residential rollover. Those are all basis carry forward transactions. If I gifted you a property, you'd have, and by the way, that stepped up basis, if it goes away, the gifting is going to be more and more of an issue. You better work with your tax bill, figure out how to be gifting stuff with the least tax also, and look at minority interest discounting and so on and so forth. But if you look at that purchase price can vary depending on how you're getting. Today, if I passed away and my wife and kids inherited property from me, they'd get stepped up basis, current market value. Capital improvements, every dollar you put into a property, either expense or capitalize. If you capitalize, it increases the basis. If you expense it, you wrote it off, and it does nothing to do with that basis. Depreciation. Depreciation is one of those things where the government's position is you should have taken it, therefore you did. So if you've got an income property, you've got a rental house, let's say, and you haven't been taking depreciation on it, by law, you've got to take depreciation on it. You could be audited and you could be tagged for tax on depreciation recapture that you never got the benefit of. So once again, it's really important that you're working with good tax people. And just a simple question of, and like I said, yesterday morning, I had a meeting with a CPA. We're going through stuff, and I asked her, I said, well, gee, when you work with people and they buy a property, how are they ascertaining the most basic cost seg? Cost seg is used on institutional type properties typically, but you're going to break it down into flooring, lighting, electrical, plumbing, all these different things. But the most basic form of cost seg is, let's say, on a rental house with dirt and improvements, right? And so that situation, I asked, I said, well, who makes that allocation up? And she and her firm, they actually analyze what's going on with it. But a lot of people might look at the property tax statement or throw a dart at the board. I don't know. But you think about the repercussions of increasing the value of the improvements versus decreasing the value of improvements. By simply increasing the value of the improvements, you've got more depreciation to take and you've got a better ROI. So, really understand even that most basic rental house, that cost seg in baby sense between dirt and improvements makes a huge difference in things. So in a situation where, let's say we've got a recessionary situation, and I've sort of been waiting for this to happen, if you've been on our presentations, you hear me talk about it, where we've got phantom gains. So if we go back the last crash and we start looking at things where people were losing properties to foreclosure or doing short sales on assets, people would say, well, gee, one, I didn't get any money on this. I lost money on this thing. How can I have a tax consequence? Or maybe I lost the property foreclosure. How can I possibly have a tax consequence? Well, on a primary residence, you've got some tax relief there. On income properties, you don't. So you've got to understand, if the debt exceeds the basis, the debt's going to be treated as the sales price, and you could have a tax consequence even in a foreclosure. So it's really important to understand that. Once again, a great reason to go and talk to your tax people before anything happens. And in a foreclosure, what happens is the property is transferred to us pre-foreclosure. So we would get a call, this thing's going to happen, and the ownership would be transferred to us pre-foreclosure. That transfer starts the clock. No money would come into us, like I said, but the question was easily answered, because if you look at the tax consequence of a sale, or in this case, the tax consequence of a foreclosure in today's tax rates. Now, this is assuming that we continue. The rates on your screen today are long-term capital gains tax rates on assets held for investment. So typically you're going to be looking at, and it's income dependent, but typically our clients are going to be looking at 20% federal tax on appreciation, 25% on depreciation recapture, another 3.8% on the healthcare tax. Those are all federal. Then state taxes could range anything from 0 to up to 14% now in California. Some states, if you look at this, you look at Washington, it's showing 0 there. But if you look at normal income tax rates, okay, so if they got rid of the long-term capital gains tax rates, now we're looking at, it's income dependent, anything from 10 to 37%. Here's your tax brackets on normal income tax. So you think about how this is going to impact your life. So think about staring at a federal tax rate of 37%, and you live in California. Now you got another 14 on top of that. What's that? That gets you to how much? 51%. Plus, you could be sitting at another 3.8 on the healthcare tax. So you do the math, you understand what it does. By the way, when you sell a property, that gain gets put on top of what you make in a given tax year and would put you into one of these tax brackets. So really understand what is being talked about and what potentially what impact it could have on you if you're a broker, what potential impact it could have on your investors. What do you think is going to happen with that market? So this is, once again, 2024 tax brackets. This is straight from the IRS. And this is what you're looking at. If they were to get rid of long-term capital gains tax and on top of that, get rid of 1031, you wouldn't have anywhere to go but to pay these taxes. A map of the country and the tax rates. So I've got to fix the California one. It's changed, but you understand why those gray states are popular. Not only are they popular from the perspective of the zero state tax, but they also typically are going to give you more ownership rights, which we just keep seeing more and more erosion of property ownership rights. You think of what they're talking about right now with AI with rental rates in different places and what they're wanting to be limiting your ability to do. And understand a lot of the rent control. Back to the comment on that proposal to get rid of 1031, talking about the uber wealthy. No, most of my clients are just regular people, lots of mom and pops that have been blessed to accumulate enough properties to live off in their older days. And you start thinking about getting rid of Social Security and different things, and it really would be problematic. But this thing with rent control, what happens is you've got people that can no longer address those things. And especially if you think back on COVID, where there were governors basically telling tenants, well, gee, you don't have to pay the owner. And what's the owner's bank going to say to them about making payments? So it's really a tough situation. And we've got lots of situations where things are being forced upon people and they just can't, they can't afford to deal with the ownership of property anymore. And so they end up looking at our end games video, or honestly going into Delaware statutory trusts, a lot of them, institutional tenancy and common investments. You're going to hear more and more probably about 721 UPREITs. We're going to talk about it today because I think it's the ultimate installment sale if you're wanting to do that thing. So this is like I said, these are the rates for the most part. There probably might be a couple changes from this last year, and California I know has changed, so I'll have to make that change on it. Things that people say, they're just wrong. So remember I said anytime you read something about what you know something about, you know how wrong it is. Lots of people say, well, gee, I remember Like Canning meant house for house, land for land. It's never meant that. There's been proposals that would have made it be that, but it's never been that way, and hopefully it never changes to that. In the late 90s, there was a proposal to take farmland out of the like kind because they were concerned that farmers were selling their land and that working land was being taken out of production, and that was not a good thing. And so they were looking to get rid of it, and fortunately that didn't happen. 1031 does not require 2-year hold. Like I said, there's no required hold in the code. The 2 years that's in the code has to do with a related party transaction. So you do an exchange. So you can sell to a related party in exchange. You just can't buy from a related party in an exchange. The exception is if both of you are doing exchanges and both of you hold your respective replacement properties for no less than 2 years. The fine print of that, even a related party transaction, says it's a 2-year hold unless there was no intent to avoid tax. Well, you could argue what's 1031. It's not avoidance, it's deferral, but I can see them fighting on that stuff. So just understand, typically if you're doing a transaction with a related party, you ought to plan to hold the properties, each of your respective properties, for no less than 2 years. 3, there's no limit to the number of properties relinquished or received in exchange. The idea rules imply there are, but there are not any limits. You could give up 20 properties, buy one. You could give up one and buy 20. It really is totally irrelevant. I'm going to tell you, if you're doing more than 3, you probably ought to get them done inside the 45 days, because after that 45th day, you're stuck with what's been ID'd, and you're going to be looking at, in that situation, I can't imagine you're working with 200% rule, so you're probably working with the 95% rule, which means you got to close 95% of the aggregate value of all properties ID'd. That can be a tough thing. You can, so today's topic, you can carry a note or a land sale contract and still do an exchange. So lots of people talk, well, you can't carry paper and do an exchange. Totally wrong. You can. There's a variety of ways to utilize it. We're going to talk about those. And then the next one, number 5, is a very big one in today's world too, because we've got lots of people looking at loans that are a reduced loan to value. and therefore you're having to add money to that transaction, and lots of times they're being told, well, you have to replace the debt in exchange. No, you don't. Debt can go away two ways. One, by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding money to the transaction. So if you gave up, let's just say, a $500,000 property with 100K in debt on it, and you want to go out and buy a $500,000 property with no debt as a replacement, do it. That's totally fine, not a problem at all. But if you go from a $500,000 property down to a $400,000 property, you're going to have some tax exposure because you went down in value. All right. Finally, 1031 is not all or nothing. So remember earlier I talked about offsetting gains with losses. If you want to pull a piece of your equity out in a transaction, you can do it, and you've got to let us know and let escrow know, because we're going to get that. We're going to out it from the exchange. So we're going to exclude that money that's going to be received at close. It's going to be specifically excluded via our assignment agreement. If you don't have that exclusion in the assignment agreement, you have a potential issue there. So if you want to pull some money out, go take a trip, buy a boat, do whatever you want to do, that's fine. You're just going to have exposure on that money coming out, and you can pull it out at close. You can't pull it out afterwards. If the money's come to us, you can't get it out until you've purchased everything you have the right to buy. So understand, if you want to pull money out, when you can do it, and that time to do it is at close, and we'll exclude it from the exchange. But 1031 is not all or nothing. 4 basics. 1, it's got to be an exchange. Something's going to be given away, something's received. As far as you're concerned, you're selling something, you're buying something, you're paying us to structure an exchange. 2, the items relinquished and received must be of like kind. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. You can convert a property that you acquire via 1031 into a residence. You can take a residential property and convert it into an investment property pre-sale. You just have to season these changes. But there's reasons to convert investment to residence. There's definitely reasons to go residence into investment these days. So we're going to go investment to residence, residence to investment. It doesn't really matter. There's reasons to do both things. And you're going to use, typically people are looking at using 121 and 1031 to take care of situations. We talked about the 5-year hold earlier, and your inability, let's say, to get rid of gains by completing an exchange, converting it to an investment or to your primary residence after, let's say, a year or so, living in it for 2, selling it, taking the exclusion. Again, if you did that within 5 years of sale, fully taxable. After 5 years, you're going to get prorations of deferral. The prorations based upon the amount of gain attributable to qualified versus non-qualified use periods from April of 09. So just be aware that that is there. And what was a great idea no longer is. I say if somebody's going to buy a property, convert it from investment to residence, they need to just figure they're going to plan to live there into perpetuity. And look at it that way. Don't think, hey, I'm going to do these things, I'm going to get rid of the gain via conversion and going that way. The reason people would convert a primary residence into an investment is that universal exclusion of 250 or 500, which I would argue probably ought to be $1 million, $1.5 million, and $2 million today. If you look at $1997, the 250 or 500 meant something. Today, it's ludicrous. It means absolutely nothing. So I've never heard anything from either party talking about increasing those numbers, and they really need to be increased so people can, sort of live out their days in the properties and be okay. And if they're going to sell, they've got some money. A lot of times people are moving out of properties these days and going to senior living facilities and they sell maybe their life home, and now they've got huge tax hit. It's sort of a sad deal. So what you do is you move out of the property, and maybe you sell it after a year of time. You don't have to rent it. It's just got to be held for investment. When you sell it, you're still entitled to 250 or 500. The overage would go 1031. So that's why we'd be going back and forth on stuff. 3, the napkin test is what we have to do to satisfy the exchange. You need to go across or up in value and equity for total deferral. I didn't say anything about debt, did I? So across or up in value and equity. Finally, we've got to have continuity of vesting. That just means the person or entity that gave us something has to be given something back. It's more easily said than done. The lending world is at odds with the law on this sometimes, because if you look at 4 units or less and you go through traditional financing, those are considered residential loans, and they don't allow typically an LLC to take ownership. So you're really looking at portfolio lenders, regional banks that are going to do those things if you're 4 units or less and wanting to buy in an LLC. Now, why that's important is this vesting issue comes up. Let's say I'm sitting here in Portland, Oregon. We're not a community property state. So you and your spouse might buy a property, get another one. Now your lawyer says, hey, you ought to shove them into an LLC because it's going to protect you. And now you're in a situation where you sell that, maybe a single family rental or a plex, and you go into another plex, 4 units or less. And so you relinquish the property in an LLC. You're now wanting to acquire it individually. In a community property state, you can't do that. In a community property state, you could, because let's say in California or Washington, it would be fine to give up the property in an LLC that you and your spouse are members of and acquire the replacement property individually. But in a non-community property state, you can't do that. Diagram just showing like kind graphically. I'm not going to really talk about it much. We've already talked about like kind. The one thing I will point to is at 10 o'clock, a 30-year leasehold interest in property or a lease with extensions, right to extend to 30 years constitutes like kind real property. So if you're buying in the desert, maybe Hawaii, sometimes you're in a situation where you don't actually, you've got a leasehold interest in the underlying dirt. And you got to make sure those leasehold interests are going to satisfy what you've got going on there to make sure it's like kind. Napkin test, we talked about it. Just once again, a crosser up in value and equity. That's what is important. And in the middle, you can see in bold, debt can go in 2 ways. Reduction of value triggers tax. It went down in value. The other is to add money, which does not trigger any issues for you. So this is what we have to do for total deferral. And remember, 1031 is not all or nothing. So you pull funds out as you want to do that. Just know what tax consequence you're going to be looking at, and you're good. Vesting, like I said, second biggest headache we've got. Time's always the biggest issue. Vesting's the second biggest because, as I said, depending on community versus non-community property state. But anytime if we've got, let's say you go out and buy an investment with 5 of your close friends, you're not going to own that thing forever. So if you buy it and you create an LLC to own the thing, what do you think the odds that everybody's going to want to go the same way on a disposition? Inevitably, somebody's going to want to just pay their tax and go away. And so we've got to really look at that, understand that partnership interests are specifically prohibited from 1031 treatment. We've got to really look at what's happening. So if you've got joint ownership of a property with a group of people via a limited liability company, you're either going to do a drop and swap, or a swap and drop probably is our industry slang. And it just means that you would convert that LLC interest, you go into a tenancy in common, maybe a year, 2 years pre-disposition. So you now season the property as being personally held, and then you can go forward. If you didn't make that change before disposition, you could complete the transaction into a number of properties, and then take and transfer ownership of each of those respective properties to the respective investors maybe a year downstream of the exchange. I like to do that. If what we would do in that situation, if we got it, let's say half dozen different properties, we did the exchange for an entity, I'd do a half dozen different LLCs with the exchanging entity as the member of each of those. A year after acquisition, you do an assignment of membership interest from the entity to each of the respective investors for each of those properties. Now everybody is where they are. You didn't have change title of those things. The downside of that is that if you've got debt on those different things, you could still be encumbered with that debt, the recourse debt, if it exists on the respective replacement properties. But once again, it's all planning. Understand, rarely is a question whether we can or can't do something. It's just a question of taking the time to understand it and work forward, asking those questions and making it happen. Get that good team of people together to talk. Seller finance and tax. Okay, I had a conversation a couple weeks ago with a tax attorney that just loved the fact I talked about this, because so often he had watched the videos and he'd seen the presentations talking about the tax repercussions of an installment sale. People don't think about it, or they're just told, hey, I'm just going to pay tax on the principal payments, as they come in. Long-term tax rates in today's world, the interest payments are going to be normal income tax, and that's it. And I'm going to be paying tax on the down payment and future payments as those things work. Well, that's not true. I mean, that's true, but in addition to those, the biggest issue is you're going to have tax exposure on debt relief. If you had debt on the property, you're going to have tax on debt relief. And if you've taken depreciation on that investment, you're going to have tax on debt relief and depreciation recapture in the year of disposition, whether you received a single payment or not. So really take the time, work with your tax people. If you're considering selling and carrying paper, one, I've got to tell you this, whose paper is it? Don't let the nice buyer provide that document for you, or the nice buyer's lawyer provide that document for you. If they've done that and you're going to go along with it, you better get your lawyer to review that thing and get your tax people to look at it and understand what it says and what potential issues it's going to open up for you. I'm seeing blind assumptions in these things. I'm seeing no prepayment, no acceleration provisions in them. And I'm seeing people being told that they can do an exchange when the balloon payment comes in the future. None of those things are accurate. So if it's your paper, make sure that it's doing what you want. If you're being sold on the idea, hey, you get 10 years of income at this rate. One other comment I'll have is I'm seeing people trying to buy these things, offering the seller, to buy on this note or contract, and that interest rate on that seller finance in some cases is less than what a bank's going to charge. That's ludicrous. It's always going to be more. So really, understand what's going on there and what you're doing. And if you're the owner, you're the seller, it's your paper. Make sure it's taking care of you. The reason you got to have an acceleration provision in there is because what would happen if you sold the property thinking I've got 10 years of income here, I'm guaranteed, and so I've got 10 years to spread that tax consequence over it, and I'm going to be getting 7% on the money during that period of time. That's great, wonderful. Well, the buyer comes in, now we've got the feds talking about a rate drop, so all of a sudden now they want to do a refi of the property, or maybe they decide they want to sell it. Both those situations could result in a balloon payment for you that you didn't think you were going to be looking at. So that's really important that you've got some type of acceleration provision in there. Blind assumptions are crazy because you've got the asset, you're selling to this person, you know them, but if they just flip the thing to somebody else, how do you have any control of who they're selling it to? And will they continue to honor, to get this thing happen? What happens if they default and the thing goes away? So you know who you sold it to, but now you got a situation where something else is there. So it's yours. Make sure it's taking care of your interests and you're protecting yourself because it's a long-term situation. And you've got the biggest issue is potential for default in these things. But on top of that, you could have the acceleration, you could have assumptions, other things that are going on. Now, I like note trust deeds better than contracts. Contracts arguably are easier to foreclose because if I sell to you on a land sale contract, I've got title until you pay me off. No trust deed, the buyer's going to get title of the property, and I've got a note secured by that deed. So, David, why would you like the note trust deed better? Well, I'll tell you why. Because if I'm the seller and I sell to you on a note trust deed, and you're a good borrower for me, well, if I don't want to get paid off at the time you decide you want to sell the property, and I don't want to get paid off on that, I could elect to allow you to put a substitution of collateral in that thing. So we could sell that property and we could secure my note with the new property or with your house or any other type of thing, and it would keep my income stream going. So the other thing is you can just have escrow a lot of times draw the note trust deed too. But I just like them because you've got that right to substitute collateral, and I just think that's really a nice thing that's there. So note trust deed, land sale contract, wrap contracts, we really, note trust deeds typically are used today. Land sale contract, it's sort of funny, a few months ago I had a deal, I think we're talking about it at the end, where I had our clients, I had both sides of the transaction. Our buyers 180th day was literally the next day. Their financing blew up. Our other clients selling the property, they wanted, first they talk, well, gee, we're just going to blow up the deal. I said, well, do you really want to do that? How long is it going to take to get you, another buyer in here? You guys, you like working with these guys? Why don't we do a short-term seller carry? And so some of the people involved in that transaction had never seen a land sale contract because we discussed wrap contracts in that scenario. And really in that situation, it was a short-term note. It was just going to be there for maybe 30 or 60 days till the permanent financing was going to be put in place. So we've got to understand, yeah, I mean, you might have a loan that's got an acceleration provision in it, but you've got a right to remedy. And typically, if the lender is getting paid what they're supposed to be getting paid, and this thing's it's going to be replaced with permanent financing before that ever gets to be an issue, typically. But we hadn't seen wrap contracts in probably 2 decades, and all of a sudden, they're popping up, and we're seeing deals that are subject to existing financing, different things there. But typically when we're looking at these, we're looking at note trust deeds or land sale contracts, and each of those has its ups and downs. I like the note trust deed. It's just better. It's easier for us because when you sell the property, just as the funds would come to us in a normal transaction, what happens is we end up the beneficiary of the note, and we've got a variety of opportunities that we can work with to get that stuff taken care of. So note trust deed. See, I'm so excited about talking about this stuff that I got ahead. So this page just talks more about the note trust deed and the right of assignment. This page talks about the land sale contracts and what's going on with that stuff. Wrap contracts, what am I talking about? Well, there might be an existing loan on the property, and the buyer is needing to get this thing done, and you, the owner of the property, agree to have a new contract that in effect wraps the existing one. So an example might be, you might have $1 million property with $500,000 in debt, and you decide you're going to carry let's say $900K for the people. So basically you got that contract that you're going to be paying. You've got a contract with the seller for a contract on 900, let's say, and that seller is then going to be paying that underlying debt there. Now, you as a buyer, you're vulnerable, because what happens, the underlying lender finds out this has happened, and now they accelerate the loan. You've got to be prepared to pay the thing off if to get where you need to get financing in place that's going to allow you to keep the property if somebody has an issue with that wrap contract. But we are seeing them done. Most title escrow companies are not going to do them these days, but there are some that will do it. Just be aware that they are out there. So remember, I talked about fallacies of 1031, things you couldn't do. Well, one of them was you couldn't carry seller finance, and that's totally wrong. There's actually 5 ways to deal with a note. We can, once again, the note, and I'm going to run through this with the note trust deed transaction. So as the cash comes to us, the note comes to us. We're the Benny of the note at that point in time. You're not. So what'll happen at that point is we've got the cash to go buy something as we would in any exchange, but we also have to use the note somehow. We could sell the note to a third party, which honestly, the discounts sometimes are in excess of the tax consequence in today's world, which I don't understand. If it's a first, it should be a great investment. I mean, I've got lots of IRA 401k clients that want to sell it. They want to buy notes and provide financing for people. So if you're looking at, maybe buying a note, understand that, or you're carrying it, the note better not be for anything more than you're happy buying the property for. And 2, once again, you better have some type of acceleration provisions in those things to take care of what's happening there. But you got to really look at it, understand what's going on there. So we could sell that note to a third party. Doesn't happen very often. We can use the cash and note to buy the replacement property, and that rarely happens too, because the seller of the replacement property didn't know anything about your property, doesn't know anything about that borrower. But I have done those transactions. We've actually cross-collateralized those things once in a while. So it has happened where we've done these, where we use a note and cash to buy something. Purchase the note. What do I mean by that? 9 times out of 10, we've got seller finance. Our client, the exchanger, buys the note from us. And you're going, once again, David, why would I buy my own note? Well, what you're really doing is substituting cash for that note, which allows you to defer all the gain. And now, so instead of, for example, if we had a note of 500,000 that was in there, and you got 500K sitting in the bank, what are you making on that money versus maybe doing a seller carry? You buy that note, and it could be anything from, let's say 7 or 8 in today's world to 20 in some instances. So you just look at what's happening there, and there's lots of reasons where I've had people borrow money from a bank to buy their note out of the exchange. So that option happens more often than any others, at least with our firm. and it can work out very well for people. So once again, what will happen is the note comes to us, and the cash comes to us at time of sale. Anytime prior to the purchase, you'd come in with the money representing that note, and then we complete the acquisition. And you might, ching ching, hey, we talked about selling to a third party, and we talked about discounting there. So I got a great idea. How about, David, I'll buy the note from you, and we'll discount it just like we would to a third party, and that's a great thing. Well, the discount, what does that note represent? It represents equity. You discount the value. Now you're pulling equity out of the deal. Now you've got tax exposure. That's food. So that discounted value for you to buy your own note, that's not a good idea. All right. Then we've got short-term notes. Now I mentioned to you that collapse financing on that deal. Well, we've got a situation, maybe the property's not financeable. Maybe you can't buy it because it needs a new roof. Maybe it needs something else. Some lender required repairs have to be done. Maybe it's a time issue. Any of those things could come up. Well, if the seller will agree to a short-term note, what will happen is the note comes to us once again. When the note gets paid off, we now have the cash to complete the acquisition as we normally would. Finally, we've got the ability to do a partial exchange. If the down payment is in excess of basis, we would be able to defer gain on that down payment, and then you could just take the note and pay tax on that over time. So those things are all possibilities, all ways to work with seller finance. Notes in a reverse exchange. So in a delayed exchange, that seller finance greatly complicates the transaction. In a reverse exchange, actually I'll back up. Selling and carrying paper is where the issue is. Buying from somebody carrying seller finance, if you're in an exchange, that's always going to be fine. So whether you cash something out, whether you get traditional financing or get seller financing in an exchange, it doesn't matter. It's all good if you're on that buy side. We're just talking about seller finance on the relinquished property sale. That's where the note or contract causes problems. So, in a reverse exchange, understand how things work. So in a reverse exchange, basically the exchanger is going to loan us the money to buy the property. All right. So if you go out and you buy a $500,000 property, and maybe if we're buying it before the sale happens, it's a reverse exchange. So maybe it's $500,000. You're going to show up the purchase with the $500,000. We buy that property, and we will ideally continue to own that property via what's called an EIDA, exchange combination title holder, which is really just industry lingo on a single member LLC that Equity Advantage is the member of. So you show up with the $500,000. We sign a note saying we borrowed that money from you. When you sell in the future, the proceeds from that sale come in, we repay that debt that we've got to you. And if there was money in excess of the debt, if there was a loan on the replacement, we could pay down that loan, or you could go buy something else with the excess, or you can pay tax on the excess. But who's to say we've got to pay you back with cash? Couldn't we just pay you back with a note? So in a reverse exchange, we have a debt to you, and we can take the proceeds from the property that's going away, the relinquished property's note could be used to repay the debt we've got to you. So reverse exchanges, seller finance, it's a beautiful thing either way, on the purchase or on the sale of the relinquished property. The key to any reverse is obviously that you've got to have the financial ability to buy today to replace something yet to be sold. So 721 UPREIT. Okay, there are, so if we look at a traditional installment sale, we've got no trustees, land sale contracts. If you look at an institutional form of an installment sale, it could be a structured sale, which evolved out of structured settlements. And basically a third-party assignment company steps in, assuming the obligation to pay you over the term that you want to get paid. So for somebody that just wants to shift gain from one year to the next, or shift gain out for some reason, then that structured sale can be a nice situation. But I like in that transaction, you're still looking at installment sale consequences. So the 721 is really a neat thing, because what you're doing with a 721 is you're exchanging into a Delaware statutory trust, or DST. Now, 1031, as we all know, you've relinquished property held for investment, you're acquiring property with the intent to hold for investment. So when we acquire the DST, you've got to hold that thing. So if you go onto a sponsor's page and you want to say, well, gee, how long do I hold it as a DST? You're not going to see a hold period there. It's going to be up in the air, because if all you did is buy a property with a set time that's going to get converted, the IRS could come in and argue you held it for resale, not investment, and nullify the exchange. So you're not going to see that kind of stuff there. And then once again, 1031 does not have a stated minimum hold. I mean, I give you a court case where 4 months was defended, successfully defended. But you typically, I'm going to tell people a year for a couple different reasons. But in this situation, you're going to complete the transaction in the DST, total deferral. So you don't have an installment sale hitting you with any tax on the down payment or debt relief or depreciation recapture. You've totally converted all your money into this. You've exchanged into the DST, and you're totally tax deferred. Maybe a year or 2 years downstream, your DST interest gets rolled into shares of a REIT via 721, and that rollover is not taxable to you. So now you have shares of REIT. Well, why is that important? Why is that a neat thing? Probably the biggest objection to Delaware statutory trust properties is the lack of liquidity. Typically, you're buying into an investment or group of investments where you're going to be there going for the ride for as long as the sponsor decides to hold that property. And sponsors might say, okay, it's a 7-year hold. I'm just giving you a number, but they could have a hold that's less or more. And the best sponsors are always analyzing the market, watching what's going on, and they want to reap the largest benefit for you. They might also liquidate an investment earlier because they might be concerned about something too. So it's not always going to be that time period, but typically when you buy these things, you're going for the ride. Now, we have a number of people that might be looking at this as a estate planning tool too. I've got situations where people might have unfortunately cancer or something, and they might be looking at only a couple more years, and they know that their heirs, the kids, don't want to deal with investment property, or they don't know how to deal with investment property, and they just want the money. So if you buy in straight up into a DST, you're going to go for that ride. If you do the 721 UPREIT, as soon as you pass away, the shares could be sold. Now, the thing that I really think is neat about the 721 is that typically the taxation of the payments on an installment sale, as we've discussed, you're paying tax at time of disposition. If you didn't do an exchange, down payment, and then each payment that comes in, you're paying long-term capital gains tax on the principal payments, and the interest is normal income tax. But you're going to pay tax on all the gain first, and then you get to your basis, and then from that point on, you don't have any more tax consequence on those payments, right? Well, the UPREIT flips it upside down. So you're going to get paid through the basis first, and then you go into that gain. So it's really a neat deal. And the other thing is you're not worried about the buyer defaulting or an acceleration of these things. You've got shares of that REIT that you can sell at any time you want. So if you want to know more about this, keep your eyes open. We'll probably have a presentation just on 721s coming up, and reach out to us, and we can get you some more information that's something that's of interest to you. A couple examples were done. So in this situation, we talked about this scenario. These are all transactions we did. The buyer's financing failed. Buyer and seller are both doing exchanges, and now we're in a crunch period where you've got a choice. The seller could decide, gee, I'm just going to pull the plug on the deal, and we'll wait for another buyer. Well, a lot of times that seller's already picked their replacement properties, and they're banking on the sale or need the sale to go buy those properties. So a short-term seller carry can satisfy the needs of both the buyer and seller, get the deal done, and then the permanent financing gets put in place later. So even if the property is not financeable, that short-term note and trust deed can take care of the transaction, get the deal done, and then everybody is where they want to be and still able to defer things via 1031. So this is just a lender required repair in this one. The first example was literally financing blowing up, unable to get the thing done. This scenario, we just have lender required repairs that prohibited the actual closing to occur until those repairs were done. And so the short-term seller carry could take care of that and make things happen. Now, if you're doing lots of improvements to a property, you're going to start looking at, how can I get those improvements done if it's beyond seller or beyond lender required stuff. And a lot of times we'll say if it's a small amount of improvements, maybe you ask the seller to do those improvements, build it into the purchase price, so we're not having to do a reverse exchange, or we can do a reverse exchange, or not a reverse, an improvement exchange, where we're going to buy the property, own it, do the improvements, convey the improved property to you, completing the transaction. But for things like this, that short-term seller for lender required stuff, short-term seller carry is going to be the solution to get you where you want to go. This is just looking at what people want to do and understanding what these things can do for you. Pulling money out of transaction immediately predisposition. People think, well, gee, if I put a new loan, pull some money out immediately predisposition, I'll have the money, I'm okay. Well, that's a step transaction. If you do it after acquisition, I'm going to ideally wait a couple weeks, but you want to make sure that if you do it after acquisition, you do the exchange, complete the transaction. After you've acquired what you do, hold it for a little bit, then do the cash out refi. That money's there to work with as you want and get you where you want to be. So just understand the repercussions of refis pre and post exchange and what's going to happen there. Take a look at, if you've got questions on anything 1031 or even investment stuff, take a look at our YouTube channel. There's hundreds of videos up there on everything from 1031. If you want IRA stuff, take a look at our IRA Advantage YouTube channel. But you're going to see things, everything from seller finance. We've got videos on companies that offer notes to be purchased. We've got life contract sales. Why would I have life contract sales in there? Well, because lots of people get to a point where those contracts get so expensive to maintain. As people get older, they can't afford to maintain them. So a lot of people just let them lapse. Well, check with one of these vendors, because they're often worth something or worth a lot of money, and selling a life contract could be a good thing for you. Cost segregation's up there, and obviously anything 1031's there, but qualified opportunity zones, OZs, QOZs are there. We've got information from different DST people, institutional tech people, but hey, worst case, if you're having a hard time falling asleep some night, take a look at the thing. But I hope what you've listened, heard today has been helpful. I encourage you to reach out with any questions or concerns you've got, and keep an eye out for what's coming up ahead, and really understand what each party is proposing going forward. Think about how it's going to impact you and your life, your family, and potentially the whole country. I thank you very, very much for being a participant today. If you would like continuing education credit, we are able to provide it in certain states. Reach out to cmore@1031exchange.com, cmore@1031exchange.com, and she'll get you a certificate of credit for that. And as far as the slide deck, it's available, and this thing will be available online on YouTube for future viewing. So all my best to everyone out there, and look forward to talking with you soon. David Moore, Equity Advantage, 1031exchange.com. Have a wonderful day. And one last comment, this is August, end of August 2024 for future context. Bye-bye.